This is not it. Oh, yeah. This week in economics on the 2nd of April 2016. And let me just check some things here. We are live, so I just want to make sure that, okay, we're fine. Nonetheless, we'll get right into this. We'll talk about the latest jobs report, and from the people at market, we'll look at some PMIs here also. We were trying to find our theme song. It took us a bit to find it, but nonetheless, everything does appear over time. We just make sure that we have these are the flash service PMIs. We'll first, however, go to the numbers here. The employment situation, as they call it. This is released. This is for March. It was released on April the 1st. No All Foods joke here. The total number of payroll employment rose 215,000 in March. Unemployment rate was little changed at 5%. Now, we've talked about this before. 5.5% is considered the normal rate these days. During the administration of G.W. Bush in the early 2000s, we used to talk about 4.5%. No doubt it is moving in that direction. In March, the unemployment rate 5%, and the number of unemployed persons at 8 million. were little changed. Both measurements have shown little movement since August. That would be of 2015. Major groups, the unemployment rate for adult men at 5.4, adult women 5.6, teenagers 15.9, for Europeans 4.3, for African Americans 9%, for Asians 4%, Latinos 5.6%, little change there in March. The number of long-term unemployed, we talk about this quite a bit. That's 27 weeks or more, which could be a year, were essentially unchanged at 2.2 million in March, has shown little movement since June of 2015. In March, these individuals accounted for 27.6% of the unemployed, or those who had been made redundant. In March, the labor force participation rate at 63%, and the unemployment population ratio at 59.9%. Little change. Both measurements were up 0.6% since September. So there's some improvement. You're hearing the campaign, or in previous campaigns, about the labor force participation rate. In the current debates during the primary season in the U.S., you hear really very little about economics. You hear creation of jobs, but basically no specifics there. The number of persons employed part-time for economic reasons, also referred to involuntary part-time workers, was about unchanged at 6.1 million, and has shown little movement since November. That's 2015. These individuals would have preferred full-time work. In March, 1.7 million persons were marginally attached to the labor force, down by 335,000 from a year earlier. That would be in March of 2015. The data was not seasonally adjusted. Among the marginally attached, there were 585,000 discouraged workers in March, down by 153,000 from 2015. The remaining 1.1 million persons marginally attached to the labor force in March had not searched for work, reasons, school attendance, etc., family leave out there. Now, this was the household survey. The establishment survey, total non-farm payroll employment rose by 215,000. Employment gains occurred in retail, trade, construction, healthcare, while job losses occurred in manufacturing and mining. Retail trade added 48,000 jobs in March. A little bit unusual. Over time, we used to see rise in retail trade around the holidays, and of course on the back-to-school sales. All that has changed with online marketing, etc. Employment gains occurred in general merchandising stores, 12,000 there. Healthcare and personal healthcare services, 10,000. Building materials and gardening stores, 10,000 there. They are getting ready for spring. Auto dealers, 5,000 there. That's a good sign. Over the past 12 months, the retail trade has added 378,000 jobs. Construction employment rose by 37,000 jobs in March. Construction gains occurred in residential specialty trade contractors, 12,000 there. In heavy and civil engineering construction, 11,000. And over the year, construction has added 301,000 jobs. Employment in healthcare increased 37,000 over the month, about in line with the average monthly gain in the prior 12 months. In March, employment rose in ambulatory healthcare services by 27,000, in medical centers by 10,000 over the year. healthcare employment has increased 503,000 over the month. Employment continued to trend up in food services, drinking places, 25,000 there. I can attest to that. Any block you walk on, there's a tavern, an eating place, etc. In financial activity, 15,000. In March, employment in professional and business services changed little from the third month in a row. It averaged 52,000 jobs per month. Employment in manufacturing declined by 29,000 in March. Most of the job losses in durable good industries, negative 24,000, including machinery, negative 7,000. Primary metals, 3,000. Semiconductors and electronic components, 3,000 there. Mining employment continues to decline, 12,000 losses there, concentrated in activities for mining, 10,000 since reaching a peak in September 2014. Unemployment in the mining has decreased by 185,000. Employment of major industries including wholesale trade, transportation, warehousing, information, and government changed little. The average work week for workers on private non-farm, I'm interested how they put that in, is unchanged at, 34.4 in March. Manufacturing work week edged up 1/10 an hour to 40.6, little built-in overtime there. Employment overtime 3.3 for the fourth month in a row. In March, the hourly earning for all workers on private non-farm payrolls increased 7 cents to $25.43. And a debate in California to raise the minimum to $15 in 6 years. 2% decline in February. Minimal there, so we won't even spend time on it. Changes in total payroll employment for January was revised from 172,000 to 168,000, not unusual for the winter months. The change for February was revised from 242,000 to 245,000. With these revisions, employment gains in January and February combined for 1,000 less than previously reported over the past 3 months. Jobs gains have averaged 209,000 per month. That is roughly 150,000 to 200,000 below what we need. We need basically 350 to 400,000 to pick up the extra slack. Now, there would be a lot of debate there in terms of what they normally refer to as overheating. But at the present rate, you will have little inflation involved out there. You go to the market PMIs. This is the final one for manufacturing. Let's see what we're going to do. Oh, we'll do manufacturing first. This is for the U.S. And output growth unchanged from February is a month low. Modest upturn in new business volume. Price changes there. And the summary, March data highlighted sustained growth across the U.S. manufacturing sector, but the overall pace of expansion remained subdued. At 51.5, up only slightly from 51.3 in February. Seasonally adjusted, this is the market final manufacturing purchase manager index, signaling another modest improvement in operating conditions. The earlier flash reading was 51.4. Moreover, looking at the average here, let's see, for Q1 at 51.7 The headline PMI points to a weakest quarter upturn since Q3 of 2012. A faster increase in incoming new work and sustainable growth of employment numbers were the main positive development recorded by the survey during March. The latest data also points to stabilization in export orders, following a slight fall in February. Manufacturers note that generally improving global economic conditions have helped offset some of the negative influences on export sales from the smaller dollar. Now that has subsided somewhat, despite a slightly sharp rise in Newark manufacturing output growth was unchanged from a 28-month low recorded during February. Moreover, output growth remains below its post-crisis trend and close to the lowest since 2012. The relative weak rise in production volume was linked to subdued client spending patterns so far this year, and a corresponding lack of pressure on operating capacity. Reflecting this, a backlog of work were required to have fallen again in March, which extended the current period of decline to 4 out of 5 past months. Manufacturing companies indicated cautious inventory policies in March. Post-production stocks were broadly unchanged, as has been the case throughout 2016. Stocks of inputs were reduced from the 4-month running, and the rate of decline was the fastest since January 2014. Survey respondents linked this fall to relatively subdued output growth and heightened uncertainty about the business outlook. At the same time, growth of input buying was only marginal, following a reduction in February. The latest survey highlights a sustained decrease in average cost burden across manufacturing sectors. Lower input prices have now been recorded for 7 months running, although the latest decline was only marginal. Where a dip in input costs was reported, manufacturers mainly cited the impact of lower commodity prices. We'll talk about the oil scene in a minute. Manufacturers reported a further reduction in their factory gate changes during March, but the rate of decline was modest since February. Survey respondents attribute the latest fall to competitive pricing strategies and lower input costs. And the comment here is from Tim Morse, senior economist there. March's survey highlights sustained weakness across the U.S. manufacturing sector, meaning that overall growth throughout Q1 slowed to its lowest point since late 2012. Subdued client patterns within the energy sector, ongoing pressure for a strong dollar, generally uncertain about business outlook, were cited as factors weighing on new order flow in March. And of course, in the U.S., it's a presidential election year. Meanwhile, price discount strategies resulted in the first back-to-back drop in factory gate changes from around 3.5 years. For around 3.5 years, suggesting another squeeze on margins despite lower material costs across the manufacturing sector. Now, this is a service PMI here, the weak rise in service PMI output since December, the weakest I should say. A sharp slowdown in new business growth. Business confidence among service providers slipped to its lowest since 2010. Solid pace of hiring maintained in December. December's data highlights a renewed slowdown in output growth across the U.S. service sector. Seasonally adjusted market U.S. Service PMI Business Activity Index, which is based on 85% of the usual monthly respondents registered. Wait a minute here. Just a second. I want to make sure that we have the right one up here. And this is December's. Is actually the wrong one. How this came to us, I'm not really certain about, but let me just look at one little situation here and make sure that we get the right one up. That sometimes can bring about what we actually do not want to bring about here. And just a second here, make sure that not exactly what we wanted. Oh well. Anyway, this is one of the when you're doing a live commentary, it's sometimes not the best to do it live, but we do in fact sometimes do it live. And I'll run back here and make sure we get the right PMIs here. This was a manufacturing PMI, not the one we wanted, unfortunately. Oh well. Anyway, on we go. Let's see, news release. This was December. Okay, maybe we'll get the right one up here. Now, this is a manufacturing news release, not the one we wanted. Anyway, we'll come back to that later. Let's roll right on here back to the BBC, and we'll do some of the rest of this. Oversupply will move to the oil sector. When in doubt, move on. And talk about petroleum, where it is. A slump there on Saudi comments. This is from the BBC. This is the Prince Mohammed bin Salman. Anyway, the price vowed to increase production following the lifting of sanctions. They are worth more than $2 trillion. It would be designed to reduce Saudi's reliance there. But the plan would be the sale of shares, well, anyway, in some of their state-owned Aramco starting next year. And if countries agree to freeze production, we will move along. But there is no freeze there in terms of production. And of course, crude oil fell $1.63, and we'll get to that in a minute, down $38 to $38.70. Survey by Reuters showed that oil output for 13 OPEC members rose in March on higher production from Iran and near record exports from southern Iraq. So we're continuing to see this. In February, Saudi Arabia and the Russian Federation would freeze outputs at January labor levels if other oil producers would agree to it. And there's obviously no agreement at all on what will go on there. And this was with Bloomberg Oil This is the $2 trillion fund. Let me get to this. This is mega fund for post-oil era. The deputy crown prince said that Saudi Arabia is ready for the twilight of the oil age by creating the world's largest sovereign fund for the kingdom's most prized asset. Now, this was from the deputy prime minister there, Mohammed bin Salman. Laid out the vision of a public investment fund which will eventually control more than $2 trillion there. And there's a picture of him. We'll put it up here. Transferring shares of Aramco, that's their state-owned thing, which technically makes the best source of Saudi revenue, not all. The prince said the royal component in Riyadh, royal compound, in Riyadh. That is their capital. The sale of Aramco, Saudi Arabian oil company is planned for 2018, a year earlier, according to the prince. The fund will play a major role in the economy, investing home and abroad. It would be big enough to buy Apple, Google, Alphabet, Microsoft, and Berkshire Hathaway, the four largest public trading funds out there. The blueprint for structural changes follows a series of measures last year to curb spending and prevent budget deficits from exceeding 15% of GDP. At the end of December, authorities raised the price of fuel and electricity and pledged to end wasteful spending after oil prices plummeted. Moreover, the quick fixes as part of a national transformation plan. We are working on increasing efficiency of spending, as Prince Mohammed said, who is second in line to the throne, a much younger man. The government used to spend up to 40% more than allocated in the budget, and this whittled down to 12% in 2015. And struggles to strength their hydrocarbon habit. And we'll put this graph up. International Monetary Fund noted that many examples of failures by countries trying to reduce reliance on energy production, and few succeed. The Gulf area monarchies may have missed their best chance when oil prices were above $100 a barrel. No doubt about that. It's clear Saudi Arabia needs to reform, diversify, and they are also in solar energy. That's Paul Sullivan, professor of security studies at Georgetown University, but it will involve more than just increasing investments in non-oil industries. One cannot order economic reforms like a multiple course dinner, he says. Prince Mohammed has more power than anyone in his position since the founding of the kingdom in 1932. As a defense minister, he leads the country's military effort, oversees ministries including finance, oil, and the economy through the Council of Economic Development Affairs. Yeah, well, anyway, when we had his headdress on, his headdress off, it's already started to be more active abroad. In July, the PFI acquired 38% stock in South Korea's POSCO Engineering and Construction Company for $1.1 billion. And the same month, it agreed to a $10 billion partnership to invest in Russia with Russian Direct Investment Fund. So they're moving around also. They're working now on different fronts. Now the government is transferring some of its assets, land, some companies there to them. So nonetheless, the price and several top, this is a multiple course dinner. I'm not sure why they use this. Overseas, very aggressive there. And this is what they are planning to do. We'll put this on our Twitter feed. So things are directly changing. We got that story out there. I don't know if we have our Baker Hughes up or not there. But in Zimbabwe, black ownership declines. Let me grab this very quick. Oh, deadlines for firms to be black-owned passed. The government has said that companies should meet the requirement of a 2008 digitization law by the end of March. Theoretical non-compliance would lead to companies losing their license, a key part of Dr. McGarvey's campaign promise. The Reuters quoted the minister responsible, Patrick Zivko, as saying that most government foreign-owned banks and mining companies have not submitted their indigitization plan, adding that they would do so. Strange thing. So here's a Barclays sign here, bank. BBC Africa report, they have it, attempts to implement the law 2 years ago was largely ignored, but this time the government is promising action. So will they suspend some of these? Let's wait and see. At the time of the process of transformation of around 4,500 farms held by Europeans, distributed to 170,000 native Zimbabweans or families begin, and this is widely blamed for causing economic collapse. But a study by Essex University found that the program had some positive effects, and the idea that it was a complete phase, a myth. There's no doubt about that. That was just sheer propaganda put out by these various allies of the former apartheid arrangement there. Let's see what else we have here. More the same from Brazil. Change in copyright laws. The safe harbor, that's an interesting situation in the music business. It is out there now in the digital privacy laws. The Copyright Office, who has jurisdiction, are studying it. They announced they were reviewing the so-called safe harbor, protected division of the digital rights regime. But Congress would have to change the law itself, the Digital Millennium Copyright Act, which has a lot to do with the way that we look at things. Let me quickly go to Reuters here. We never did get the market report up, but we'll just have to scuttle with it and get Reuters here, since we are moving live. And the job report was obviously the big one, as one would say, but sometimes we have more than that, and we don't want to miss anything. We don't have Alaska Airlines near deal to buy Virgin America for $2 billion. This is from Reuters. And this is what we looked at earlier here, a leaked report of an IMF transcript on Greek debt. Greek demands an explanation for the IMF fund, International Monetary Fund, on Friday after an apparent leaked transcript suggested the IMF may threaten to pull out of the country's bailout as a tactic to force European lenders to offer more debt relief. They'll resume talks in Athens on fiscal and reforms. Hadn't been in the news very much. The review has been adjourned twice since January due to a rip amongst the lenders over the estimated size of Greece's fiscal gap by 2018. Internet whistleblower site WikiLeaks published what it said was a transcript of the March 19th conference call from three senior IMF officials there. The officials were quoted as discussing a threat that the fund might not participate in the third bailout program for Greece, especially to Germany, to reach an agreement on the debt relief before Britain's June referendum. Now that's on the EU. And we have stated clearly that what we think is needed is for a durable solution to the economic challenges facing Greece. One put Greece on the path of sustainable growth, sponsored by a credible set of reforms, matched by debt relief from its European partners. That's the IMF there. The proposed conversation involved Paul Thornton, head of the IMF's European department. And however, the transcript of Genuine appears to suggest that Thornton saw a more prospect of IMF applying pressure on the German Chancellor Angela Merkel to concede debt relief to keep the fund involved in the bailouts and secure Greece's cooperation in managing refugees. So a lot of that. The Greek Prime Minister Alex Tsipras told a weekly newspaper Eros, it seems that some people are playing games with an aim, to destabilize us. We will not allow the IMF Thornton to destroy Europe. So this is interesting. We don't know exactly where that is going. I'll see if I can get the WikiLeaks transcript and peg it to our show notes later here. There's a possibility. I'm not certain if we'll be able to do that or not. And one last visit to market and see if we can find this item. And maybe we can, but we'll see if we can. We usually are able to find these, but okay, here we are. And we may not have one actually. We have the manufacturing PMIs. We'll see if we can get a service PMI here. Maybe not. Now we do have all of them lined up here. Well, the U.S. Eurozone. Oh, there is none. Okay, that answers our question. So now we can go and do the numbers. Yeah, when something's missing, we always want to know where it is. Anyway, we'll find out very, very quickly here. So I'll find the numbers. We'll do the markets. These are from Friday, unless otherwise noted. And everything is in the negative here. The FTSE All-Share on Friday at 15.83. In Amsterdam, they were at 5.63. Frankfurt, the DAC, was at a negative 170.87. In Paris, they were at negative 62.82. In Brussels, negative 15.96. In Madrid, negative 120.80. In Zurich, negative 119.55. In Moscow, negative 7.61. In Johannesburg, negative 294.82. In Bombay on Friday, a negative 68.94. In Karachi, 310.62. That was in the positive. In Lahore, they went in negative 45.11. In Colombo, 11.13. In Tehran on Wednesday, 919.10. In Sydney on Friday, negative 78. The Nikkei on Friday, negative 94.151. The Hang Seng in Hong Kong at negative 277.78. In Shanghai, 5.61. In New York, 107.66. The Nasdaq at 44.70. The Commodities Exchange, the Chicago Mercantile out in the Midwest, 13.04. And in Sao Paulo, 506.25. And finally in Mexico, 181.84. Let's look at commodity prices, starting with Brent crude. And here we go. The Brent crude futures. What do we have here? It was down. We gave this one earlier as down $1.65 at $38.68. The spot was down 87 cents at $38.73. West Texas Intermediate crude fell $1.63 at $36.71. T-Boone Pickens still jumping for joy. $15 a barrel oil, which is basically about the same thing. Give a mic up here and make sure we're beaming to you correctly. Anyway, nonetheless, cocoa was down $69. Coffee down 20 cents. Gold futures on the Forex down $1.50 at $1,232.10. Dubai gold futures up $7.20 at $1,233.60. And let's quickly go down to the Eunex Life futures here. We had cocoa down, $30? And Robusta coffee down $18. White sugar, I don't know why we do this, down $8.20. The Bloomberg Commodity Index down 89 cents at 77.94. So this will do it for us. For those in business, make next week a productive one. And we'll probably not be live next week. We are live here on the iHeart Network, Spreaker Network. So thus we have finished one more week of This Week in Economics here. And we'll talk to you next week unless we have special scheduled programming. Good day.